Hello everyone, Mark here at TSLA, and I have a new video here in regards to the price action for Tesla on July 3rd, 2023. I'm recording this on the 4th, so happy Independence Day to everyone in America. And let's take a look at the stock. It closed up 6.9%, and the closing price was $279.82. And as you guys know, this big gap up was because of the deliveries for quarter two of Tesla. The production and delivery numbers were very much above consensus, which led to a little bit of a little rally here. So before we dive into smaller time frames, let's look at what the ranges we were talking about, this consolidation that could be happening before earnings for Tesla. We had a really good catalyst to give us a movement to the upper part of that possible consolidation, but I'll draw it out here for you. I'm starting it around the beginning of the month, slightly into the gap as the low part of the range, and we'll move it to the right to the 19th, which is going to be the earnings, and that's coming up really soon. And we talked about around 289 to 290 being the top of this consolidation, so it would look something like this. And there's some good reasons for this. I added for the first time in my video the volume profile that goes back a year and a half or so. That kind of shows you the activity at certain price points, and you can see, because of this ranging and consolidation from last year, that around the $300 mark, coincidentally, that's also a very psychological number, around the $300 mark, you're probably going to see a lot of people come in and do something. And that do something is most likely sell. But we're currently are in a little bit of a low point in volume. And that's why we can move so easily between the 260 and that 280 mark. And that's why when we got up to this similar number a couple weeks ago, it sold off so quickly. It's because you're getting back into this volume shelf that there's a lot more interest in. And usually this is taking profit, and this is people that are swing trading. They're getting out of these positions right around here because, number one, they already caught a really good move. Number two, it's like psychologically a tough number to get through. And you saw it take place for months, basically, last year. And this was right before Jackson Hole's speech from Jay Powell, and of course the acquisition of Twitter and all the other stuff that obviously affected what happened to our stock. But we're getting back into that very similar range. But it'd be surprising for us to break through what I believe is our consolidation range before earnings. Earnings is actually really close. Like, it's only going to be a week and a half away, I think. So you don't have to wait too much longer. But I really do believe that even if you see upward movement, that getting to 290 would be tough. But if it isn't tough, then yeah, I think you'll get sucked right up to the 300 mark pretty easily and just settle there for the earnings. So if you see us kind of continue to bull into the 290 area, you can probably play that move for another $10 before earnings. I think that if you get through that point, it would be a safe bet that 300 would be where the price would sit at for earnings, and it would be a make or break point time for Tesla. But if you zoom out, obviously we're not anywhere near highs. We are well off the lows though, but sitting right in the middle. And that's where the market makers like to put us, in a situation where it isn't easy to go long or to go short. It's you'll see that in a lot of tickers earnings or before certain events. Like, you don't know which way it's going to go because it's there for a reason. And it's because it's a pivot that's going to send it crashing or send it pumping really hard. Let's zoom in on a smaller time frame. We'll go to the minute and look how the day panned out. Of course, we had I'm going to delete the range so it's easier to see. And I'll turn off the moving averages, which we're trading above of. So I'm not really going to talk about them because we're above them. So turning off the moving averages, and you can see the action a little bit more clearly. Now, it was generally a flat day. And even though we peaked pretty high, it really made sense that when it got to 285 that it would start selling off. But it wasn't like it was just Tesla by itself. We'll take a look at the indices a little bit later, but most of the indices and most stocks were relatively flat until the end of the day. All of this was taking profit because people know that they're going to another event, which is going to be earnings. So a lot of people don't want to stay into it. The people who are selling obviously are not people like you and me. They're not investors. These people are traders. And a lot of people trade Tesla for one reason alone. And the price action probably confuses you. And it is really because people they like the liquidity of Tesla. Like if you compare like Tesla to SPY, which is the S&P 500 ETF, or the QQQ, which is a NASDAQ ETF, Tesla's option volume is comparable or higher on a consistent basis than those tickers, which is why people are in this name. It's not because they like Tesla. It's not because of any other reason. It's that it's very liquid. A lot of people are trading it, even when it gets expensive. A lot of people are trading it still, and a lot of people are playing options. So they're counterparties to options, or they're swing trading or shorting or what have you with the rest of you because you guys make it really interesting. But Tesla sold off when it hit the 285-ish, the 284 mark, and the rest of the market kind of trailed for the rest of the day as well. It was a nice move up, and there was almost like an obvious short going down into around an hour before close or so. And then you saw a lot of buying in tech names. You didn't really see the buying, I don't believe, in the more not mundane, but the less exciting names weren't being bought up towards the end of the day. One of the names in general that we're seeing a lot of buying is the semiconductors. They were being bought up like basically at the last minute of the day. Everything kind of sold off in the after hours though to make it a little bit more flat. Tesla is going to, I really don't think that you're going to see much upwards movement. So don't be playing short-term options, I don't believe, on Tesla right now. Like if it's expiring Friday, I just don't see a lot of information that's going to make it cover a big distance until Friday morning, probably. Also, later we're going to be looking at the calendar for the economic news, and the most important one being, I believe, PC inflation. Not PC inflation, ADP, which is going to be payrolls, and also NFP, which is non-farm payrolls. So all the jobless reports and the job numbers reports and job opening reports are coming out Thursday and Friday. Those are going to be your catalysts for a big movement, but it won't give you a lot of time. Like this week is short, so it's not going to give you a lot of time to make a big move. So short date options, maybe not so great because the catalyst isn't there. Next week, maybe you'll have an opportunity, but 2 weeks out, 2.5 weeks out technically, might be a better expiration. So look for 21st of July, 28th, and into August, as if you're playing options, maybe those are better dates for you. Buy yourself some time so you don't have to sweat it. I think anything this week is that's out of the money is going to be kind of a waste, and people are getting chopped up through to the weekend and one half day trading yesterday and a holiday today. These options are going to do nothing. They're going to do nothing. But not to mention Tesla's earnings, what also can affect the outcome of Tesla's price action towards the end of the month is like so many other tech names are reporting. So just kind of be careful. We'll talk about hedging if Tesla starts getting up higher and higher towards 300. We'll probably talk about hedging and what are some plays that we could do, or I can do. This is not financial advice, that could help minimize downside in case the margins kind of tank, or if there's upside, how do you compensate for your hedges? So Tesla's flat, but let's take a look at S&P 500 so you can see, S&P 500 is pretty flat. Let me chart off my averages so you can see what we're doing here. And also I'm gonna, first thing, let's zoom out on the daily. Let's do like a kind of macro look on the S&P 500. And we'll do that same thing on the NASDAQ as well, so you can see what the overall market is doing and how Tesla's kind of playing into this. Just like Tesla, as higher and higher we go into the pricing of the S&P 500 and NASDAQ, you're going to see a lower and lower volume profile, which is allowing stocks to move up pretty rapidly. And you can take a look at how that really works by seeing how we had that long consolidation during the spring of this year. And once you break through it, it kind of just gets sucked up until it hits another profile, which is going to be kind of this consolidation here at the top of this range here, this consolidation here, and all these other peaks here and here, that it kind of slows it down because there's interest in this price. There's interest in, especially 440, and there was interest a lot in the 432 area just because of the collar, but that was also kind of just above the peak of August at Jackson Hole last year. If you see any good catalyst for upwards movement, I think the movement would be pretty quick up to 450, or even just the 452, 450 area right here where this kind of peaks, but also it kind of coincides with that April high of last year, before things tanked from inflation, interest rate hikes, etc. And so this move can be done by just looking at the calendar. Like, you probably can see this move. If the move is going to happen, it's going to be by the end of the month, most likely. When you get through Microsoft, Apple, Meta, Amazon earnings, the move is going to happen by then. So could there be like a little ranging? Possibly. Can you, if we have some bad jobless numbers, job numbers, I'm sorry, do you see us filling the gap? Yeah, it's possible. But we're leaving some gaps behind, but not too many. Can you see that? Yeah, it's very possible that can fill, and then give you the opportunity to go super long if you want to, into earnings, which would just it's an easier setup. Like, you don't have to go long right at this peak. Like, if you're looking at where we're at right now, we're basically floating around the previous high in the middle of last month. So either that this is going to be a nice weird cup and handle thing, or we're gonna dump, depending on how earnings works out, and how the job numbers can temporarily send you a little bit lower, but it's the earnings that are really going to affect what type of trend we're going to pick up. If it's going to be a continuation of an uptrend in a bull market, or the beginning of a new bear market. But when it comes to earnings, like, we already had essentially what was an earnings recession in a lot of tech names. We've already had a good sell-off and a good consolidation. Sideways movement is basically just destroying that any obvious a trend in pricing. So you could say to yourself, like, yeah, look how long sideways you've been. This is essentially going nowhere. This isn't productive for the stock market and people's investments and what have you. But what it does is it kind of cools off what could have been a large injection of liquidity from COVID. It can cool off the kind of overbought conditions that went into it. And I think that you don't have to see lower lows, and the lowest of lows all the time to kind of get that out of the system. Now, I understand there's still a lot of savings and a lot of cash sitting on the sidelines, but this has been a long drawdown. Like, we're not anywhere on the S&P 500. We're not anywhere near the highs. If I was to measure, let's see, we are 7.5% down. And the time that it's taken to get back to 7.5% down, it's been 546 days. It's like a year and a half of going nowhere and going pretty low. So if you want to see what a recovery could look like, let's look at COVID, just to see if this rally off the October lows, if this is a lot to some people. This is 27.8% from the October lows. And if you just want to start from the spring lows from in March, we are up only 16.9%. And a lot that for some people that seems like some insane amount, that a big correction needs to happen because of that. But let's just take a look at what V recoveries look like and compare it to our little baby recovery. So starting from the low of COVID, until we saw a decent pullback, 62%. And if that's not even, if that pullback is just healthy, like until we started selling off, that was 119% move on the S&P 500. So we've gone 27%, was it? 28%, 29%, 27%. This is nothing compared to what a real bull market could look like. And if AI is going to be the catalyst for the next bull market, secular bull market, then what does 119% look like? Let's just say what does 100% look like from the lows of October? Well, it looks something like, well, it's not even on my screen anymore. All right, what does that look like? Let's zoom. Did I zoom out enough? That looks like, see, that's how stupid that would look, and that's how stupid COVID looked. That would be insane. That's ridiculous. But the market always goes up. The market will eventually go back up. It's not going to stay low forever. It's not going to sit below its highs forever. It's eventually going to go back up. The reality is a lot of people missed out, and that's how the way the market wanted it to be. Even though a lot of people weren't positioned in the market, the people who are driving this price, they didn't want anyone to get in without having to pay a pretty hefty price to get positioned. Um, yeah, that's just the fact. So it's very possible, but we're at that moment where by the end of July, you're going to have all the earnings out for the most important names, the biggest market caps in any of the indices. So get ready for that. Let's take a look at the Nasdaq. The Nasdaq had a similar move to S&P 500, but didn't equal the high for the middle of June. So we're still below that, and we were also, just like the other names, we're getting in that low volume in this profile that could allow you to, if you see some good reason to bull, the bulling would be very, very quick. It's going to be really quick. It's going to be like you might have a pause for 1 week after going up 2.6% to around 380, and then a 7.25% move with good reason. And you'll probably settle here, which is going to be near the highs. But to really think about it, like that's 7.5%. Like, what does 7.5% look like from the consolidation? That was this, and that took half a month to do. Apparently, yeah, it took about 16, 17 days to go 7.5% after breaking out of the consolidation earlier this year. So it could happen really, really quick, and the timing is perfect. So it's the 4th that we're recording. What does 17 days look like? That's right before the end of the month, where we would have like Alphabet and Meta and Amazon reporting. So it's lining up that it's going to either just kind of sit around here. If the news is slightly good, we'll probably sit around the 380 mark. And if things go really, really well to the end of the end of the earnings season, then you can match all-time highs relatively quickly within 2 weeks from, let's say, when Tesla reports. But a lot of people are telling you that we're in a recession. A lot of people are telling you that earnings are down from the previous year, except for Tesla, possibly. And that there's no reason we need to go up. But you got to realize, like, if the market always worked on lagging data itself is lagging. Like they're compiling information from 1, 2, 3, 4, 5 months ago. And why would the market react to that to determine if it wants to go up or down for the future? Like, the whole point of the stock market is that they're predicting what your earnings could be in the future, what your revenue is going to look like, how's your company progress in the future. It doesn't care necessarily what's being done in the past. What it kind of does what it needs is to know, like, some macro data information, like, is inflation cooling, and is the consumer still strong? Like, those are some tidbits that can play into the roll into the future, as far as like, okay, so we know inflation is stagnant and it probably will be stagnant, and they can adjust accordingly. But if everything that will happen in the future is determined by what happened in the past, like we'll be going nowhere. We'll be flat for years. The market is going to be forward looking, and it's going to move in a way that it's going to be very difficult for people to anticipate and to get in. Look, we've been down a lot. The Qs have been down a lot compared to the even S&P 500. Can I remind everyone what our drawdown is from the high to the lows in October? This is a 37.7% drawdown. That is huge. And how long is it taking to recover? It's been a very long time. You guys don't even know. You might not even know. It's been 590 days. Like, we're gonna get to the 2-year mark, and we're still lower than what it was back in the peak in the end of 2021. So yeah, so I would say that we're getting to a really good position, that a little bit of good news is going to send this index flying even faster, obviously faster than the S&P 500. This is more volatile. It's a higher beta stock. This is technology based, and I think, not financial advice, that it's looking good. We just have to see what earnings look like for the end of the earnings season. Look, everyone knows earnings is not going to be great. That's already priced in. All of this action here, all this selling off, this is pricing in an earnings recession. This is pricing in not growing year over year or quarter over quarter, unless you're Tesla. So like I mentioned, I want to take a look real quick at the economic information that's going to be coming out at the end of this week. Let me switch over to the Market Watch economic calendar. And this is what I use for most of my calendar data. So Wednesday, the day after the holiday, really nothing's really going on other than the minutes of the Fed's June FOMC meeting. So how do you play this? Like, let's say the market opens up, and you can watch the futures market tonight. Futures open on holidays at certain hours, so you can kind of have an idea what's going to happen in the morning. Well, if you watch it in the morning, if it's slightly up, let's say it's 0.19% up, and it kind of raises very slowly over the course of the day, then the meeting minutes could really affect how the price action is going to finish up for the day. Meaning that what we want to see with the minutes is what is the consensus of further rate hikes? Why is a dot plot what it is? Why are we factoring two more rate hikes by the end of the year? And who's really on board with that, and why? That's what we want to see. And if you see any dissent when it comes to further rate hikes, if you see any like questioning about the dot plot, I think you can see a decent close. Nothing spectacular. There's no reason for it to do very, very well tomorrow. There's no big earnings this week at all. Everything starts next week. Thursday is going to be a little bit more important. We have ADP employment numbers. This is like kind of a precursor to the bigger non-farm payrolls on Friday. What do you want to see here? The expectation is it's around 220,000. When it comes to jobless numbers, it's really hard to understand how the market's going to react to them. But safe to say, you don't want big surprises anymore. You don't want big surprises to the upside. You don't want big surprises to the downside. What does downside employment numbers look like to you? You can either take it two ways, and they actually might be correlated with each other. Is that number one, that a lower employment number means, okay, the job market is cooling, the Fed has done its job, and that they don't have to raise rates in July and September of this year. What if employment is higher? That means a stronger economy and rates can stay on, right? But if you want to go back to being lower, if jobs are lower, are we going into a recession? Are we in a recession? And that can mean rate cuts eventually, or even closer. But it doesn't mean that the economy is going to be great for equity and stocks. And you might want to be in bonds at that point in time. I don't know. Initial jobless claims. So initial jobless claims is, people that are fired or let go from their job and they're signing up for benefits. And this number has been off, just like all the other job numbers. Analysts have never gotten anything close for the last 1.5 years as far as what the actual is compared to what the consensus is that they decide. So jobless claims, you want something in line with expectations. You want people to understand, okay, yeah, we understand that these are high numbers. These are high numbers compared to recent history for a lot of people that are getting let go. But it's part of the process to getting the economy back to the labor part of the economy to get back to a healthy point, to understand that rate hikes are no longer needed because the demand is being destroyed by rate hikes to the point where businesses are letting people go because they can't support the excess number of jobs that they hired for. Could be a good thing, but what you want to see something in line, something a little bit lower, something a little bit higher. No more surprises on job claims, but from recent history, there's always surprises. These people don't know what they're doing that are analyzing the economy. U.S. trade deficit. I know we had a surprise net import increase so why our GDP did so well recently. It was I think it's a 2% revision up from, was it 1.4%? Is that we just had this net import surplus for some reason. Like I mentioned with the GDP revisions, there's 2 or 3 revisions for every GDP report. So every month they're making sure the numbers are right, and it's found out we imported more stuff. That's our GDP went up because of it. Expectations are probably lower for a trade deficit because of that. But it's not going to really move the market as much as the jobless claims will and the ADP employment claim. And ADP employment numbers will. Those are going to be the 2 pre-market things that move. Job openings, you need to start seeing these job openings in the 9 millions. I wonder if I think did we see one recently was in 9 millions, but this whole 10 million stuff, no, because Jay Powell, he looks at these job openings, he wants to see this lower because, in essence, for him, you don't need to. The way he can see, the way J Powell sees a soft landing happening, meaning that we don't go into a crazy recession to cool off this overheated economy, is that you see job openings come down, right? So people that, and what does that mean? So if job openings come down, the recent job mobility has been really, really, really good for the person looking for jobs. Like a person could easily quit their job and find another job that's paying higher. So it causes what some call like a wage spiral inflation, where people have such mobility to bounce from job to job looking for higher pay because there's so many job openings. And so you can keep wages down and you can cool off the economy by seeing a lower number of job openings. And that means you're not firing people, but they're stuck in the job stuck, quote unquote. They're in the job they're in, not getting paid more, doing another job. And they're just like, there's no wage growth, right? Other than promotions, raises within the company itself. So seeing a lower jobs number, seeing flat employment numbers, seeing flat jobless claims, that's the ideal outcome for Thursday morning. This is going to be after the open. So you're going to have some time to hedge if you need to, but the move will probably happen in the morning. But if it's really, really high, this will be an opportunity to watch out for any quick volatility in the morning. PMI and ISM services, these are measurements for how healthy the business side of the economy is doing. You're probably going to want to see it like very, very, you're probably going to see it very, very slightly under expectation. What do you want to see? If you see a beat, just barely over. Strong business activity from these readings. It's just like seeing a good jobs report where it's like, okay, the businesses are surviving this high interest rate environment. But the reality is from previous surveys, most of the respondents are having a really tough time. And that's why PMIs all over the world are doing really, really poor. It's just businesses are struggling to survive. It's just that in America, we're much better off than elsewhere. Like you don't see it as much as you see it in Europe or in Asia, for instance. Like if you go to like Disney or some theme park, or you go to a tourist spot like on a beach, you're gonna see a shit ton of people. You're gonna see a lot of people out, and it's almost like if you follow the economy, you feel like you're living in a crazy world because you understand how tough it is for businesses, but the individual seems like they're doing fine. There's two realities there. Number one is, yeah, maybe it's not as bad. It's because we had a large buildup of savings from COVID due to stimulus. There is less expenses because a lot of people aren't having to pay for quite a while their student loans. And the other reality is that the economy is actually just fine. And we are just so sucked into seeing all these like flashing indicators, like, oh, the yield curve is the most inverted it has been in like 20 years. But the people in the market, the participants that trade, that invest in this economy, we're getting more and more familiar with how these indicators. We're getting more and more, we understand more and more how the market responds to the economy. And so if you're a market maker, if you're a big player and you understand, even the most novice trader knows that an inverted yield curve now means a recession, then you can't use that as a way to sell off the market. It needs to be something completely different because everyone's prepared for it already. The more and more that this generation goes through the drawdowns that it's been seeing in the last, since .com, like a lot of people in their 30s were born right before the .com bust happened. They lived through .com. They lived through the GFC. They lived through the Chinese scare back in 2014, 2015. We lived through the the first time we tried tightening in the end of 2019. We've lived through COVID. We've lived through all these things. So if we're all educated in how the market responds to economic data, then maybe economic data is not going to be the thing that sells off the market. Like, you have to understand that everyone has been positioned for a recession for a year. Has it come? It maybe has come. Remember, recessions are determined well after the fact. So maybe our recession was the end of last year, but if you're already positioned for it, you can't sell off. Then you have to pay out everyone's puts. You have to pay out everyone's shorts. You're losing. No, it's got to be something completely new. It has to be something completely different. And until we figure out what that could be, who knows? And not to mention, with the advent of 0 days to expiration options, the old zero DTEs, you just don't have the ability to sell off the market in multiple percentages without having to pay out huge, disproportionate to what you're selling options for. So let's continue. With Friday's the bigger day, non-farm payroll. Like, this is, like, I really can't wait until all of us, everyone that's trading, everyone who's investing, we don't have to worry about something called the non-farm payroll numbers anymore. Stop it. We can't live in the market worrying about every single data drop. Oh, jobs are up 5,000 over month over month, or year over year, or oh, we have continuing claims of 1.8 million. I'm like, come on. Like, there is these ebbs and tides to how economies work. It's not going to be straight lines up, down, or side to side. It's going to go up and down as it trends, right? And it's like watching these data points, like for like, oh, it's up 1.1% or down 0.2%. It's got to end, guys. It's got to end. But unfortunately, it's not ending to this week. We are going to look at these payroll numbers. These payroll numbers are the employment number that is tracked the most by the Fed. So first things first, non-farm payroll. Expectation, 240. Previous, 339. Like, they haven't got this right for 16 months. The analysts have not got this right for 16 months. Who cares what this means? What do we want? If that's the consensus, who cares? It's just some random number they pull up. But we don't want to see this too hot. But the reality is, we've seen it hot every single time. Every single time, it is higher. Or it's hotter, quote unquote, than consensus. What do we want to see? Guys, it's always going to be, if there's too many jobs, rate hikes continue. If it's flat, they don't know what to do. They'll maybe wait for more data, maybe, perhaps. If it's a little bit lower, then even a couple thousand jobs lower than consensus really means tens of thousands of jobs below consensus. Because even the people that make these numbers for consensus, they understand they're very, very low. They're always too low. And so even a couple thousand, like say 236,000, really means like down 100,000, right? So seeing something a little bit lower could be really good for the market. Unemployment rate. So the thing about this was a big increase, 3.7%. And from the month before that, would that be like April? So 3.6% unemployment rate, best number that we could see. If you don't want any more rate hikes, flat, 3.6, flat. If you want to see more rate hikes, 3.4 unemployment. And then you will get rate hikes for sure. What happens if you see a 4? What do you happen to see 3.8? Then recession. That's all you're gonna hear for the next week before earnings season starts. Recession, we're in a recession, recession's coming, the market's gonna sell off. So you see something a little bit higher, it's gonna sell. I mean, this unemployment rate, this could be something that doesn't care about 0 days to expiration options. And even though it lines up with a Friday where a lot of options expire, this could send the market reeling if this is too high, because that's just the easiest way to anticipate a recession. Hourly wages, obviously we don't want to see any growth in wages. I have 0.2, 0.10%. That's what we want. Hourly wages year over year, we need this lower every single time. Every single time. So that's it for today, guys. Thanks for listening. And once tomorrow's trading day is over, I'll have another video out with Tesla news and Tesla price action. Thanks so much for listening. Bye.